Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. This video is the 10th episode in the multi-part series in which we're looking at the key lessons from the legendary investor Warren Buffett in his letters to shareholders over the last 40 years. Warren needs no introduction. He's the chairman and CEO of Berkshire Hathaway, one of the largest conglomerates with businesses covering insurance, railroads, food and beverages, and even tech. In this video, we'll cover the three types of businesses that Mr. Buffett describes in his 2007 letter as the great, the good, and the gruesome. We'll cover what are the characteristics of these businesses that makes them a good or a bad investment. This should help investors in assessing businesses and hopefully making a sound investment decision. To view earlier videos in this series, check out the description below or head over to our channel's page. Before we start, please smash that like button and make sure to subscribe to receive next videos in this series on key lessons from Berkshire shareholders' letters. Now, let's dive into the three types of businesses described by Mr. Buffett. Number 1. The great. Mr. Buffett starts by sharing that there are 4 elements that he looks into while assessing a business. Do we understand this business? Does it have favorable long-term economics? Is the management able and trustworthy? Is the price sensible? If these 4 criteria are met, Mr. Buffett typically likes to buy the whole business, or if management is a partner, at least 80%. When control-type purchases of quality aren't available, he's also happy to simply buy small portions of great businesses by way of stock market purchases. According to Mr. Buffett, great businesses must have an enduring moat that protects excellent returns on invested capital. The dynamics of capitalism guarantees that competitors will repeatedly assault any business castle that is earning high returns. Therefore, a formidable barrier such as a company's being the low-cost producer, that's Geico, Costco, or possessing a powerful worldwide brand like Coca-Cola, Gillette, American Express is essential for sustained success. Mr. Buffett's criterion of enduring causes him to rule out companies and industries prone to rapid and continuous change. A moat that must be continuously rebuilt will eventually be no moat at all. Additionally, this criterion eliminates the business whose success depends on having a great manager. Of course, a terrific CEO is a huge asset for any enterprise, and at Berkshire, Mr. Buffett has an abundance of these managers. Their abilities have created billions of dollars of value that would never have materialized if typical CEOs had been running their businesses. But if a business requires a superstar to produce great results, the business itself cannot be deemed great. Mr. Buffett looks for long-term competitive advantage in a stable industry, and if that comes with a rapid organic growth, great. But even without organic growth, such a business is rewarding. Berkshire will simply take the lush earnings of the business and use them to buy similar businesses elsewhere. Mr. Buffett provides See's Candy as an example of a dream business. The boxed chocolate industry in which it operates is unexciting. Per capita consumption in the US is extremely low and doesn't grow. Many once important brands have disappeared, and only 3 companies have earned more than token profits over the last 40 to 50 years. Mr. Buffett bought See's Candy for $25 million when its sales were $30 million. In the last 40 years, it has earned Berkshire around $1.35 billion. After paying corporate taxes on the profits, Berkshire has used the rest to buy other attractive businesses. Number 2. The good. According to Mr. Buffett, there are not many C's-type businesses in corporate America. Typically, companies that increase their earnings from $5 to $80 million require, say, $400 million or so of capital investment to finance their growth. That's because growing businesses have both working capital needs that increase in proportion to sales growth and significant requirements for fixed asset investments. A company that needs large increases in capital to support its growth may well prove to be a satisfactory or a good investment. One example of good, but far from sensational, business economics that Mr. Buffett provides is of Flight Safety International, a company that provides professional world-class training to operators of aircrafts. This company delivers benefits to its customers that are the equal of those delivered by any business. It also possesses a durable competitive advantage. Going to any other flight training provider than the best is like taking the low bid on a surgical procedure. Nevertheless, this business requires a significant reinvestment of earnings if it is to grow. Most of this investment for simulators to match the new airplane models that are constantly being introduced. If measured only by the economic returns, flight safety is an excellent but not extraordinary business. It requires the typical put up more capital to earn more model that is faced by most corporations. Berkshire's large investment in regulated utilities falls squarely in this category as well. Mr. Buffett states that they will earn considerably more money in this business 10 years from now, but will need to invest many billions to make it. Number 3. The Gruesome. Now let's move to the Gruesome. According to Mr. Buffett, the worst sort of business is one that grows rapidly, requires significant capital to support the growth, and then earns little or no money. Think airlines. For this industry, a durable competitive advantage has proven elusive ever since the days of the Wright brothers. The airline industry's demand for capital ever since that first flight has been insatiable. Investors have poured money into a bottomless pit, attracted by growth when they should have been repelled by it. And Mr. Buffett confesses that, to his shame, he participated in this foolishness when he had Berkshire buy US Airlines' preferred stock in 1989. As the link was drying on Berkshire's check, the company went into a tailspin, and before long, Berkshire's preferred dividend was no longer being paid. But Mr. Buffett says he got very lucky, as in one of the recurrent but always misguided bursts of optimism for airlines, Berkshire was actually able to sell shares in 1998 for a hefty gain. In the decade following this sale, the company went bankrupt twice. Mr. Buffett also talks about Dexter, a shoe business, which he says remains his worst deal ever. According to Mr. Buffett, what I had assessed as durable competitive advantage vanished within a few years. But the biggest error he made was using Berkshire stock for purchasing that business. In essence, I gave away part of a wonderful business, Berkshire, to buy a worthless business, Dexter. In summary, Mr. Buffett suggests to think of 3 types of savings accounts. The great one pays an extraordinarily high interest rate that will rise as the years pass. The good one pays an attractive rate of interest that will be earned also on deposits that are added. Finally, the Gruesome account both pays on inadequate interest rate and requires you to keep adding money at those disappointing returns. For now, that's it from us. Hope you enjoyed and learned from these lessons. Please smash that like button, and for other videos in this series, check out the description below or the playlist above, or head to the channel page and subscribe to make sure that you receive the follow-up videos on key lessons from Warren Buffett's Berkshire letters. Be sure to smash that like button. Thanks for watching and subscribe for more.